big difference is that what we see now is the Fed expansion and the CARES Act has actually put money into bank accounts, checking accounts, savings accounts, payroll accounts, far greater than anything we did during the financial crisis. In fact, if you look at the M2, which is the broadest money supply, the increase in 2020, and this is really quite startling, is greater than any single year in the last 150 years. We have data going back to 1870. 25% increase. We have never had that as a one-year increase. And when we've never had a deviation, normally this money takes anywhere 6, 12, maybe 18 months to really push into the economy. And I think the rising inflation that we're going to see as the economy opens up this year is going to cause bondholders to say, hey, you know, I'm not going to accept 1% anymore on my bond if my dollars are going to be depreciating in front of my eyes. They're going to demand higher yields, and that is why I'm a big bear on Treasury bonds.
David, why do you disagree?
Well, look, there's no question that we've had gargantuan monetary and fiscal stimulus. I would argue that without it, we'd be in an even bigger overall deflationary environment than we're in right now. So I really just think that the central bank is moving aggressively to prevent a horrible outcome. I don't think that there will be inflation coming out of it. I think there might be less deflation. You can't just forecast inflation with the money supply. You have to take a look at the velocity of money. And the reality is that the velocity of money is declining one for one with the run-up of the money supply. And that's why you've had a situation where this time last year, inflation's running above 2%. Right now, measured inflation is running a little more than 1%. And the bottom line is this: you have to have a supply and demand framework. It's not as if we're seeing this huge stimulus at a time of full employment. Full employment is way out there in the future. We have an output gap in the U.S. economy. We're talking about the overall level of idle capacity relative to GDP. The output gap is as acute now as it was in the fourth quarter of 2008. Ultimately, we got cyclical inflation about 5 or 6 years later. That's how long it may take this time around. But we're just really climbing out of a big hole right now. This is not about promoting inflation, despite what the so-called experts are saying. It's about preventing a Japanese-style deflationary outcome.
Shepard Smith here. Thanks for watching CNBC on YouTube.